One of Silicon Valley's most successful investors warns Robinhood is using tactics designed by Facebook to lock in users. Roger McNamee is the co-founder of Elevation Partners. He was an early Facebook investor, wrote the book on the social media giant, Zucked, Waking Up to the Facebook Catastrophe. So, Roger, we obviously know where you stand on these tactics. But what, I hate to say this, what's wrong with it? You start a business because you want people to be addicted to your product. That's the way it goes.
Well, listen, that's not really what I'm talking about.
Okay.
I think that the panel and Papasani had really, really thoughtful points to make here. What I want to focus on is the structural question for the long term. I'm less interested in what happened on GameStop than I am about the fact that we've now seen two groups that previously didn't interact, which is to say Redditors. And so think of Reddit as a place where people get together, exchange ideas, and a lot of things happen there, including the beginnings of major social movements. So MAGA really got its start in The Donald, which was a Reddit place as well. And so if you think about this, what happened there was you put together a group of initially very serious Wall Street investors, but who wanted to bring a certain attitude to it. And the thing, they characterized it as 4chan with a Bloomberg terminal. And so there was this very aggressive thing that was going on there, but it really didn't spill over into day-to-day trading in a way that affected the market as a whole. That really took getting Robinhood to the scale it's at now, with millions of active investors and this extraordinary level of gamification. So if you think of Robinhood as having taken all the friction out of investing and having played with fire throughout, where it's really skirted the rules, and it's been called out a bunch of times and had to change some policies, but it's fundamentally gone as close to the edge as you could possibly get at a time when, let's face it, the enforcement of rules on Wall Street is lighter than it has been in a long, long time. And so when those two things came together, you get GameStop and these other things going on. And the real questions I would be asking, and I don't have answers, I just want to know what they mean. How does an online broker, which is not taking positions in things, get in a situation where it needs $3.4 billion worth of financing over a matter of a few days? Where does that come from? What kind of risk were they taking? I've been told, and I can't prove this, but I've been told that apparently they don't ask for collateral on margin trades until settlement. Does that in fact create additional risk? Are there other things in the trading deals that they allow that increase systemic risk for the market? And I look at all this, and this may all turn out to be much ado about nothing. This may work out great for Robinhood, but I do think both regulators and the rest of Wall Street have to be paying attention, because this thing that happened here, there's nothing to keep it from happening again. And I find it hard to believe that there will be $3.4 billion available every time something like this happens to Robinhood.
Amen, Roger. I mean, well said. Now I ask you this. In a world of zero commissions, obviously Robinhood isn't making money off their clients per se, so they're making money somehow. And to me, it always goes down to the follow the money. They answer to somebody, and you have to wonder who is the ultimate, who's the puppet master in all this, and why did Robinhood do something they knew would infuriate their client base that day, understanding there might have been some capital and regulatory concerns, but there's something bigger going on here, in my opinion.
Well, Guy, I think the framing of this, you're asking exactly the right question, because the customer for Robinhood isn't the retail investor. The customer, they're the hedge funds who are buying the order flow. They're the people buying data from Robinhood. And I suspect there are other people who profit on float and other things that are going on here. But those are the customers. So this is very much like the situation at Facebook, where the people who are called users are not the customer. They're not even the product. They're actually more like the fuel. And I think to some degree, the same thing is true at Robinhood. And to Melissa's earlier point, we have to judge as a society, is that okay or not okay? And I think with Janet Yellen looking at this will be a question they ask. To what degree do you have a responsibility, if you're going to gamify something like stock trading, to also provide guardrails to ensure that people don't get overextended, they don't lose their life savings, or at least if they're going to take those kind of risks, that they've been prepared. This is a little bit like if you're in Manhattan, handing the keys to a racing car to somebody and saying, we need you to drive the length of Manhattan, but you've never driven a car before, you don't have a license, you have no idea how to drive this car, but still we need you to take it the length of Manhattan. I mean, a lot of things are going to go wrong. And I think That's what the risk is here. And we may have dodged a bullet on this one, but I worry that there will be others.
But Roger, I'm going to ask you one last question. At the ire of my producers at this point. But let's say there was nobody on the island of Manhattan, and it was okay if and the buildings could not be damaged, and the person who took the keys said, "I'm willing to die. I'm willing to get injured. That's my risk. But I want to take that sports car and I want to zip it through Manhattan." Isn't it there, right?
Yep. Well, right, but you're creating something that doesn't bear to this thing. So, Melissa, I think in that circumstance, you could make an argument that that's okay. But that is not what we have here. We're talking about a stock market where lots of people are investing. I had a friend who's a hedge fund manager who owned none of the stocks, but lost a huge amount of money over 2 days because the people who did own those stocks liquidated stocks he owned in order to cover their money. And so, there are. I look at this and I go, that situation you're describing isn't actually what happened here. And again, I'm not making a judgment call here. I'm simply pointing out that these are things that are going to happen again.
Sure.
And where the regulators, I think, should at least be weighing in. And frankly, I love this panel discussion and I love your points because these are all right on. And these are the voices that need to be heard. And we just need to draw a judgment about, in our society, where do we want to draw these lines?
Right. Roger, it's always great to get your insights. We really appreciate it. Hope to see you soon.
My pleasure.
Roger McNamee, Elevation Partners.
Shepard Smith here. Thanks for watching CNBC on YouTube.